The current state of the markets. A look at the price tag end of September 2025. When you buy a stock, you're buying a piece of a business. And the most important question you can ask is, what is the price? You want to buy a wonderful company at a fair price, not a fair company at a wonderful price. Our job today is to look at the price tags on the world's biggest businesses, all bundled together in stock market indices. To do that, we'll use a simple but powerful measuring tape called the cyclically adjusted price to earnings ratio, or CAPE. Now, don't let the fancy name fool you. It's just common sense. A standard PPE ratio is like judging a farmer by 1 year's harvest. It could be a bumper crop or a drought year. The CAPE ratio is smarter. It's like judging that farmer by his average harvest over an entire decade. It takes the price of the market and divides it by the average of 10 years of earnings adjusted for inflation. This gives us a clear, long-term view of what we're actually paying for a company's proven earning power. To understand if today's price is high or low, we compare it to history using a percentile. If a market is in the 90th percentile, it has been cheaper than it is today 90% of the time in its recorded history. It's historically expensive. If it's in the 20th percentile, it's been cheaper only 20% of the time. It's historically cheap. With that tool in hand, let's take a walk around the world and see what things cost. The global picture, the entire forest. Before we look at individual trees, let's look at the whole forest. The All-Country World Index represents the global stock market. Its CAP ratio is 29. 4, sitting at the 88. Third percentile. In plain English, the world stock market has been cheaper than it is right now, nearly 90% of the time since 1987. The world, in aggregate, is expensive. This doesn't mean it will fall tomorrow, but it does suggest the easy money from rising valuations has likely been made. Future returns will have to come the old-fashioned way, from the slow, steady grind of corporate profit growth. The American market, a premium price for excellence now. Let's look at the headline act, the United States. The S&P 500 has a CAPE ratio of 39. 3. That places it in the 98. 7th percentile. Let me be clear, based on data going back to 80, the U.S. Market has been cheaper than it is today over 98% of the time. It is in rarefied air, trading at levels seen only at the very peak of past manias. This is an extremely expensive market. You are paying a premium price for a collection of magnificent businesses. The risk is that you are paying for decades of future growth today, leaving little room for error or disappointment. The NASDAQ, home to many of the tech giants driving this valuation, is almost certainly even more expensive. Investing here is a direct bet that the future profits from AI will be so colossal they will not only meet today's sky-high expectations but vastly exceed them. The developed world ex-US, relative bargains. When we leave the US, we find a different story. The United Kingdom FTSE has a CAPE of 16, 069, 4th percentile. It's moderately expensive on its own terms. But compare it to the U.S., its CAPE of 16 is less than half of America's 39. It's the difference between a premium brand product and a solid, dependable one that's on sale. The UK market is out of fashion, and its price reflects that. Europe as a whole shows a similar pattern, a CAPE of 19, 476, 4th percentile, making it expensive by its own history. But again, it's priced at a steep discount to the U.S., representing a relative bargain for the patient investor. Japan, a remarkable turnaround. Japan's story is a lesson in patience. After decades in the deep freeze, its market has warmed up. Its CAPE is 23, 4. But here's the key. For Japan, this is only the 33. 6th percentile. It has been cheaper than this 2/3 of the time. Japan has moved from being a deep value trap to what we can now call fair value. The easy money has been made. Its future depends on companies continuing their reforms. The emerging markets, hope versus fear. Here we see the two sides of the coin. India has a CAPE of 34, 687. 7th percentile. It is expensive. The incredible optimism about India's future is not a secret. It's baked into the price. You are paying for that dream today. China is the opposite. Its CAPE is 16, 265, percentile, putting it in the fairly valued range. But the real story is in the comparison to India. China's price reflects a deep well of pessimism about its property market and economy. For the contrarian, it offers a potential margin of safety. You're not paying for a dream. You're paying for a challenged reality that might just improve. Conclusion: the disciplined path. So, the map is clear. The US and India are markets of hope and high prices. The UK and Europe are markets of caution and relative discount. Japan is fair, and China is a bet on a turnaround. The old rule holds: be fearful when others are greedy, and greedy when others are fearful. The data shows you exactly where the greed and fear live right now. And remember the final, crucial truth for the long-term investor. The market is a master of testing your patience, not your intelligence. An expensive market can stay expensive for years, rewarding those who simply stay in their seat. And a cheap market can stay cheap for even longer, punishing those who try to be too clever. Your job isn't to outsmart the market's every mood, but to outlast them with steady, unshakable discipline.